The gold market just experienced a significant shift that every investor needs to understand right now. Strong jobs data from the United States has completely changed the game for precious metals, and what happens next could impact your financial future in ways you might not expect. Gold prices dropped recently after the U.S. economy added far more jobs than anyone predicted. We're talking about 130,000 new jobs in January alone, when economists were only expecting 70,000. This isn't just a small miss. This is almost double what the experts forecasted, and the markets reacted immediately. Here's what you need to know about why this matters so much. Gold fell 0.3% to $5,062.83 per ounce. Silver also took a hit, dropping 0.6% to $83.52 per ounce, even after it had climbed 4% just the day before. The reason this jobs report matters is all about the Federal Reserve and interest rates. When the economy is doing well and creating lots of jobs, the Federal Reserve has no reason to cut interest rates. And when interest rates stay high, gold becomes less attractive to investors because it doesn't pay any interest or dividends. Let me break this down in simple terms. Imagine you have money to invest. If you put it in a savings account or bonds, you earn interest every single month. But if you buy gold, it just sits there, not earning anything unless the price goes up. So when interest rates are high, more people choose those interest-paying investments over gold. The unemployment rate also fell to 4.3%, which sounds like great news for the economy. But for gold investors, it's actually a challenge. A strong job market means the economy doesn't need help from the Federal Reserve in the form of rate cuts, which means gold loses one of its biggest potential catalysts. Ole Hansen, the head of commodity strategy at Saxo Bank, explained it perfectly. He said gold eased back from above $5,100 and silver from above $86 after the stronger than expected U.S. jobs data-tempered expectations of imminent Fed rate cuts. This lifted the dollar, which puts even more pressure on gold prices. Here's something critical to understand about the relationship between gold and the U.S. dollar. Gold is priced in dollars globally, so when the dollar gets stronger, gold automatically becomes more expensive for buyers using other currencies like euros or yen. This reduces international demand and pushes prices down even further. The December jobs numbers were also revised downward to just 48,000 jobs added. This makes the January number look even more impressive and suggests the U.S. economy has real momentum heading into 2026. For Federal Reserve policymakers, this means they can afford to be patient and keep rates higher for longer. Now, let's talk about what investors are watching next. There are two critical data points coming up that could determine where gold goes from here. First, we have the weekly jobless claims report, which shows how many people are filing for unemployment benefits. Second, and perhaps even more important, is the inflation report coming out on Friday. Zion Vauda, an analyst at Market Pulse by Awanda, made an excellent point about this. He said the CPI inflation print on Friday will be key. If we get a softer CPI print coupled with the jobs report data, that could keep gold from advancing much further and could see gold make a foray back below the $5,000 per ounce mark. Think about what that means for a moment. Gold could potentially drop below $5,000 per ounce if inflation comes in lower than expected. That would represent a significant psychological level being broken, and it could trigger even more selling from traders who rely on technical chart patterns. But here's where things get interesting. Not everyone believes this weakness in gold will last. There are major structural factors supporting gold that go far beyond short-term interest rate expectations. We're talking about geopolitical tensions, massive government debt levels, and central banks around the world buying gold at record rates. Let me explain the central bank buying phenomenon because it's absolutely crucial. Central banks, especially in emerging markets, have been purchasing enormous amounts of gold to diversify away from the US dollar. According to market data, this official sector demand continues providing structural support to gold markets regardless of short-term price fluctuations. China has been particularly aggressive in building up its gold reserves. These central banks are thinking in terms of decades, not days or weeks. They're concerned about the long-term stability of the global monetary system. They see gold as insurance against currency devaluation and geopolitical instability. The upcoming Lunar New Year holiday in China could also impact gold markets. Ole Hansen mentioned that this holiday may further dampen risk appetite and liquidity. When major markets are closed for holidays, trading volumes drop, and prices can become more volatile because there are fewer buyers and sellers in the market. Let's zoom out and look at the bigger picture for a moment. Gold started 2026 around $5,000 per ounce, which is remarkably high by historical standards. Just a few years ago, gold was trading below $2,000. So even with recent weakness, gold has still delivered massive gains to long-term holders. The question every investor should be asking is this: is this recent pullback a buying opportunity, or is it the beginning of a larger correction? The answer depends heavily on what happens with inflation, interest rates, and the overall economy over the next several months. Technical analysts are watching several key price levels. The 50-day moving average sits at $2,138, which provides immediate support. If gold breaks below that level, the next major support comes at $2,095, which is the 100-day moving average. On the flip side, if gold can push back above $2,185, it could target $2,215 fairly quickly. The chart patterns suggest genuine consolidation rather than distribution, which means this could be a pause before the next move higher rather than the start of a bear market. The gold to silver ratio is also telling us something important. It currently stands at 88-1, meaning it takes 88 ounces of silver to buy 1 ounce of gold. This elevated ratio indicates that gold is showing relative strength compared to silver, which makes sense given that silver has more industrial demand and is therefore more sensitive to economic growth expectations. Let's talk about what happened to other precious metals during this same period. Platinum shed 1.3% to $2,104.90 per ounce. Palladium actually moved to a p7/10% to $1,711.12, showing that not all precious metals move in lockstep. The differences in how these metals perform tells us something about their underlying demand drivers. Platinum and palladium are heavily used in automotive catalytic converters, so their prices depend a lot on car manufacturing and emission standards. Gold, on the other hand, is primarily a monetary metal and safe haven asset. Expert opinions on gold's trajectory vary widely right now. Jane Morrison, chief commodity strategist at Global Markets Advisory, provided an important perspective. She noted that the employment data certainly alters near-term expectations, but structural factors supporting gold remain intact. Geopolitical tensions, debt sustainability concerns, and ongoing de-dollarization efforts among BRICS nations continue providing underlying support. This de-dollarization trend deserves special attention. BRICS nations, which include Brazil, Russia, India, China, and South Africa, plus several new members, have been actively working to reduce their dependence on the US dollar for international trade. Some are even discussing creating alternative payment systems and potentially a new reserve currency backed by commodities like gold. If this trend continues and gains momentum, it could provide enormous long-term support for gold prices, regardless of what the Federal Reserve does with interest rates in the short term. We're talking about a potential restructuring of the entire global monetary system, and gold would likely be at the center of that transformation. Michael Chen, portfolio manager at Precious Metals Fund, offered another valuable insight. He observed that sophisticated investors are using this consolidation phase to accumulate positions. The $2,100 level represents strong technical support that is held through 3 separate tests this quarter. This suggests that smart money isn't panicking, they're buying. Historical precedent supports this patient approach. During the 2004 to 2006 rate hike cycle, gold experienced initial weakness before resuming its upward trend. In fact, gold appreciated 45% over the subsequent 3 years as inflation eventually outpaced rate increases. Could we see something similar this time around? The conditions are certainly different, with much higher government debt levels and more complex global economic relationships, but the fundamental principle remains the same. Real interest rates, which are nominal rates minus inflation, are what really matter for gold. If inflation stays elevated while the Fed keeps rates on hold, real interest rates could actually turn negative or stay very low. In that environment, gold typically performs very well because it preserves purchasing power better than cash or bonds that are paying less than the inflation rate. The options market is also telling us something interesting about what traders expect. The put-call ratio increased to 1.4, indicating heightened protective positioning among institutional holders. This means more traders are buying insurance against potential price drops, which often happens when people want to protect positions they plan to hold long-term. Implied volatility across all timeframes rose approximately 20%. This means options traders are pricing in a wider range of potential outcomes and bigger potential price swings in the coming weeks and months. When volatility is high, it often precedes significant directional moves, though it doesn't tell us which direction that move will be. Trading volumes increased 18% above the 30-day average following the jobs report release. This elevated activity level indicates genuine institutional interest and participation, not just retail traders reacting to headlines. When big institutional money is actively repositioning, it often signals that important changes are underway. The Commitment of Traders report, which tracks positioning by different types of market participants, showed that managed money positions decreased by 12,000 contracts. This reduction suggests that some speculative long positions were closed after the jobs data, which is exactly what you'd expect when expectations shift toward higher rates for longer. Now, let's consider the global perspective, because gold truly is a worldwide market. European gold prices denominated in euros showed slightly less volatility, declining only 0.9%. This smaller decline reflects different monetary policy expectations for the European Central Bank compared to the Federal Reserve. Asian trading sessions witnessed substantial physical buying interest, particularly from Chinese institutional investors seeking currency diversification. This physical demand often provides a floor under gold prices because these buyers are typically less price sensitive than financial speculators. They're buying for long-term strategic reasons, not trying to make quick trading profits. The London Bullion Market Association reported steady institutional holdings among central banks. This confirms that official sector buying continues despite recent price volatility. Central banks added gold to their reserves throughout 2025, and there's no indication this trend is slowing down in 2026. Let's examine what all of this means for your financial decisions. If you're thinking about buying gold, timing is obviously important, but so is your investment time horizon. Are you buying gold as a short-term trade, hoping to profit from price swings in the next few weeks? Or are you building a long-term position as insurance against monetary system instability? For short-term traders, the technical levels we discussed earlier matter a lot. Watching those support and resistance levels, along with upcoming economic data releases, should guide your entry and exit decisions. The Friday inflation report will be critical for determining near-term direction. For long-term investors, the current consolidation might represent an opportunity. If you believe in the structural case for gold, which includes debt concerns, geopolitical tensions, and de-dollarization trends, then price dips could be viewed as chances to accumulate at better levels. One strategy many investors use is dollar cost averaging. Instead of trying to time the perfect entry point, they invest a fixed amount regularly, regardless of price. This approach reduces the risk of putting all your money in at a market top and ensures you're buying some gold at various price points. Portfolio allocation is another key consideration. Financial advisors traditionally recommend keeping 5 to 10% of your portfolio in gold and precious metals. This provides diversification benefits without over-concentrating in any single asset class. During times of stock market volatility or currency concerns, gold often moves differently than stocks and bonds, providing balance. Let's talk about the different ways you can invest in gold because they each have pros and cons. Physical gold, like coins and bars, gives you direct ownership and eliminates counterparty risk. If you hold it yourself, nobody can freeze your account or deny you access. However, physical gold requires secure storage and insurance, which adds costs. Gold ETFs, or exchange-traded funds, offer convenience and liquidity. You can buy and sell them instantly during market hours, just like stocks. However, you don't own physical gold, you own shares in a fund that holds gold. This introduces counterparty risk and management fees, though these fees are typically quite low, around 0.4% annually for major gold ETFs. Gold mining stocks provide leveraged exposure to gold prices. When gold goes up, mining company profits often increase even more dramatically, potentially delivering bigger gains. But mining stocks also carry company-specific risks, like operational challenges, management decisions, and production costs. They tend to be more volatile than gold itself. Gold futures and options are for sophisticated traders only. These derivatives allow you to control large amounts of gold with relatively small capital, but they also involve significant leverage and complexity. Unless you have substantial experience and can afford to lose your entire investment, futures and options are probably not appropriate. The inflation picture deserves deeper examination because it's so important for gold's direction. If Friday's consumer price index comes in hotter than expected, showing inflation is not cooling down as hoped, the Federal Reserve might have to keep rates higher for even longer. This would initially pressure gold, but it would also validate the inflation concerns that support gold's long-term case. Conversely, if inflation comes in softer, it might allow the Fed to consider rate cuts sooner, which would be bullish for gold in the medium term. However, softer inflation coupled with strong jobs data creates a Goldilocks scenario where the Fed might feel no urgency to do anything, keeping policy steady and gold range-bound. The fiscal situation in the United States adds another layer to this story. Government debt now exceeds $34 trillion and continues growing rapidly. Annual budget deficits remain over $1 trillion despite a relatively strong economy. This debt burden will eventually create serious challenges for policymakers, and gold has historically been a beneficiary when sovereign debt concerns intensify. Interest payments on the national debt are consuming an ever larger share of the federal budget. At some point, this debt service becomes unsustainable, forcing difficult choices between cutting spending, raising taxes, or allowing inflation to erode the real value of the debt. Gold tends to perform well in all three scenarios, but especially the third one. Geopolitical tensions remain elevated worldwide. Conflicts in various regions, trade disputes between major economies, and great power competition between the United States and China all create uncertainty. During uncertain times, investors traditionally seek safe havens, and gold has been the ultimate safe haven for thousands of years. The banking sector also warrants attention. We saw stress in regional banks in 2023, and those underlying concerns haven't completely disappeared. Commercial real estate faces challenges as office demand remains weak following pandemic-era shifts to remote work. If banking stress resurfaces, gold typically benefits as investors question the stability of the financial system. Climate concerns and the energy transition are creating both risks and opportunities across the economy. The shift toward electric vehicles impacts platinum and palladium demand, as we mentioned earlier. Solar panels use silver, creating industrial demand for that metal. Gold remains relatively insulated from these technological shifts, maintaining its monetary role regardless of energy system changes. The demographics of gold investment are also evolving. Younger investors who came of age during the crypto boom sometimes view Bitcoin and digital assets as alternatives to gold. However, recent volatility in crypto markets has reminded many investors why physical assets with thousands of years of history retain their appeal. Gold doesn't crash to zero overnight. It doesn't depend on electricity or internet connectivity. It can't be hacked or seized remotely. These characteristics provide peace of mind that digital assets simply cannot match, regardless of their potential for spectacular gains during bull markets. Seasonal patterns suggest that gold often performs well during certain times of the year. The first quarter historically sees physical buying related to Chinese New Year and Indian wedding season. However, 2026 started with uncertainty due to the strong U.S. economic data we've been discussing. Tax considerations matter for U.S. investors. Physical gold and gold ETFs are taxed as collectibles with a maximum 28% long-term capital gains rate, rather than the preferential 15 or 20% rates that apply to stocks. Gold mining stocks, however, are taxed as regular stocks. This difference can impact after-tax returns significantly. International investors face different tax rules depending on their country of residence. Some nations charge value-added tax on physical gold purchases, while others treat gold as a financial instrument exempt from such taxes. Understanding your local regulations is essential before investing. Storage and insurance costs for physical gold vary widely. Bank-safe deposit boxes are relatively inexpensive but may not be insured for full value. Private vault storage offers better insurance but costs more. Home storage eliminates ongoing fees but requires proper security measures and homeowners' insurance riders. Liquidity is another practical consideration. Major gold ETFs like GLD trade hundreds of millions of dollars daily and have tight bid-ask spreads. Physical gold coins and bars have wider spreads between buying and selling prices, typically 3 to 5%. This means you need gold to appreciate by that much just to break, even if you sell quickly. The authenticity of physical gold is crucial. Counterfeit gold bars and coins do exist, especially in larger transactions. Buying from reputable dealers and potentially paying for independent assay services protects against fraud. Well-known government-minted coins like American Gold Eagles or Canadian Maple Leafs carry lower fraud risk than generic bars. Looking ahead to the rest of 2026, several major events could impact gold significantly. Multiple Federal Reserve meetings will provide updated policy guidance. Presidential elections in various countries could shift economic policies. Trade negotiations between major economies might ease or intensify tensions. Each of these developments carries implications for gold. The technical picture will continue evolving with each day's price action. Traders watch not just the closing prices, but also intraday patterns, volume profiles, and how prices react at key levels. Strong bounces off support suggest buying interest, while weak bounces that fail quickly indicate seller dominance. Market sentiment oscillates between fear and greed, and sentiment indicators can help gauge when positioning becomes extreme. When everyone is bullish on gold, it often signals a top is near. Conversely, when pessimism is widespread and nobody wants to own gold, those are often the best buying opportunities. The correlation between gold and other assets matters for portfolio construction. Gold typically has low or negative correlation with stocks, meaning it often rises when stocks fall. This diversification benefit is valuable, but correlations do change over time and can temporarily become positive during certain market conditions. In conclusion, gold stands at a critical juncture. Strong U.S. jobs data has pushed back expectations for Federal Reserve rate cuts, creating near-term headwinds for precious metals. Gold fell modestly, but remains historically elevated, trading above $5,000 per ounce. The dollar strengthened, adding additional pressure. However, longer-term structural factors continue supporting gold. Massive government debts, persistent inflation concerns, geopolitical tensions, and central bank buying all provide fundamental reasons to own gold regardless of short-term interest rate movements. The Friday inflation report will be key for determining near-term direction. For investors, this environment requires careful thought about your specific situation, time horizon, and risk tolerance. Gold isn't a get-rich-quick trade. It's a wealth preservation asset that has maintained purchasing power for millennia. Whether you're accumulating, holding, or waiting for better entry points, stay informed about the evolving macro picture and remember that patience is often rewarded in precious metals investing.